Welcome to this explainer from Talk Tickers. Today, we're diving into a really critical skill for any financial analyst, and that's identifying earnings management. We're going to break down how companies can, let's say, shape their numbers, and more importantly, how you can spot the red flags to figure out what's really going on behind the scenes.
And there's no better way to start than with this gem from Warren Buffett. It just perfectly captures the whole issue, doesn't it? This intense, relentless pressure on public companies to meet, or even better, beat those earnings estimates, quarter after quarter. And it's exactly that pressure that creates this huge gray area in accounting. It's this space that lives somewhere between a totally legit financial strategy and outright fraud. For any serious analyst, understanding this gray area is absolutely fundamental. So at its heart, this is what we're talking about: earnings management. It's basically using the flexibility that's already built into accounting rules to nudge financial reports toward a certain result. Usually, that means smoothing out earnings so they look nice and predictable, or just making sure you hit those analyst targets every time. Now, what's fascinating is that this isn't a new problem. Not at all. Way back in 1998, the SEC chairman, Arthur Levit, gave this now famous speech where he called it accounting hocus pocus. He was talking about how the natural flexibility in accounting can be exploited to paint a much rosier picture than what's actually happening.
And this is super important, you've got to understand that not all of this is illegal. This slide kind of shows you where that fine line is. On one side, you have legitimate strategic calls, like, say, delaying an asset sale. Perfectly fine. But on the other side, you've got straight-up fraud. The key difference really is all about intent and whether the moves violate GAAP, generally accepted accounting principles, which are, the basic rules of financial reporting. In that same speech, Levit didn't just point out the problem, he basically gave us the playbook. He laid out the common techniques that companies were using to improperly manage their earnings.
And here they are, Levit's 5 key tricks. Take cookie jar reserves, for instance. A company has a great year, so they overestimate their expenses, creating this little hidden reserve, a cookie jar, that they can dip into later to smooth things out in a bad quarter. Or another big one is aggressive revenue recognition, where a company books a sale before the service is even fully delivered, basically pulling future money into the present. All of these tactics are just designed to manage how people perceive the company's performance. So let's see how this theory plays out in the real world with some very real and very expensive consequences. This is what happens when the SEC decides a company has crossed that line from clever accounting into outright deception. So in 2020, the SEC came down, and they came down hard on a company we all know, General Electric. The penalty from misleading investors was massive. We're talking $200 million. And the reason why? Well, GE just wasn't being straight about where its profits were coming from. Their core businesses were facing some pretty serious headwinds, but they covered it all up by using changes in accounting estimates to inflate profits. This gave investors a totally false sense of security.
Okay, fast forward a year to 2021. This time, it's the apparel company Under Armour facing a penalty. And this case is a classic example of earnings management. It was all about messing with the timing of revenue to make growth look better than it was. What they were doing was pulling sales from future quarters into the current one just so they could hit their revenue targets. Management even called this practice unhealthy internally. It created this illusion of strong, steady growth when really the company was just borrowing from its own future. And look, it's not just the global giants. In 2022, Rollins Inc, a big pest control company, got hit with an $8 million penalty for a really blatant kind of earnings management, all to hit one very specific number. The SEC found that the finance team at Rollins was literally being told to make just enough accounting adjustments to push their earnings per share up by a single penny. The only reason for doing it was to beat what analysts were expecting. I mean, that is a textbook case of managing earnings to a target. So these cases are a huge warning sign. How can you, as an analyst, get better at spotting these issues before they blow up into an SEC investigation and absolutely destroy a stock price? It all starts with knowing what to look for, the red flags. So here are the key things to have in your toolkit. If you're hearing constant pressure from management to meet the numbers, that's a big one. Another one is a long, almost impossible streak of beating estimates by just a penny. But honestly, your most powerful weapon here is the cash flow statement.
If a company is reporting soaring profits, but the actual cash it's generating from operations isn't keeping up, something is wrong. That gap is almost always the first real sign of trouble. Ultimately, when you're analyzing any company, your work should really boil down to this one single critical question.
You have to always ask this, because at the end of the day, cash is a fact, while reported earnings, well, they're an opinion. Answering this question is the single most reliable way to cut through all the hocus pocus and see the real health of a business. This is not financial advice.